So what I want to say to you right now is risk monitors green. We get a follow-on buy trigger on Tuesday. We put capital to work. There's gaps that were left behind on all the indexes because of the gap up on Tuesday. And that's like a tantalizing place for the market to go down and test before going higher. So if we're going to put capital to work yesterday, the day before, and then the market wiggles a little bit and closes the gap or tests the gap, we can't change our position. I mean, you can. I mean, go ahead and do whatever you got to do. But in a world that's run by algos and AI, in a world where capital is being managed, more and more and more capital by algos and AI, if we don't execute like the machines, we're going to get chewed up by the machines. If we don't execute like a machine, we're going to get chewed up by the machine. So when we put a position on, we have a stop. And any volatility above that stop should mean nothing to us. Any volatility above that stop that gets us out of our position is the machine chewing us up. If there's volatility above the stop, that's expected noise. And if we're making gut decisions, oh, I don't like the way that looks, so I'm going to sell it, that's going to negatively impact our performance over time. I guarantee you that. That's a guarantee. And there aren't many guarantees in the stock market, but that's a guarantee. If you make a decision to put an investment on and it goes down the next day, but it's above the stop, and you just sell it because you're afraid, you're negatively affecting your future performance because you're letting the machines grind you under with extreme volatility intraday. You just can't do it. So when you put capital to work, you always hear me say this, and you got to really think about it. What is the risk you're willing to take? Then put the capital to work and accept that risk. Step away and just manage like a machine to the stop. The asset has to close below the stop to exit. The way I manage a position, I don't do anything in the first 2 hours of the day. Market could do whatever it wants. The position I own can do whatever it wants. I don't touch it. There's rare instances where a piece of news comes out and I might get out. It's okay. Something's changed about this investment and I have to protect. That's different. Maybe 5% of the time. So 95% of the time, I don't care what it does in the first 2 hours. You do whatever it wants. Then we go through the process. If it's below the stop after 11:30, we look at the low of the day and we say if at any point it takes out the low of the day, we're gone. If it stays above the low of the day, we give it all the room we can to see if it can recapture the level that's our stop. Below the stop at 3:30, 3:45, okay, we're out. Above the original stop, we're still in. And we probably move our stop down to the low of the day. Because you see, stops are a bit of an art, not a science. I never use stops as a hard exit. I say this is the line in the sand, and I have to see how the asset performs there. In a bull market, probably 80% of the time, it'll test the stop, close above it, go a lot higher. Okay, I don't want to mess with the position. But we've got to execute like a machine, or the machines are going to grind our performance down. I also try to remind everybody, and I'm sharing this with you right now, so you really think about the type of portfolio you're building this week, because then you got to live with it next week. It always comes back to a question of reward versus risk. It's a risk-adjusted rate of return that you should be thinking about when it comes to your strategy. A simple way to think about it, I could always dramatically outperform the market in a bull market. I could always do it because I could put all my money and invest it in triple the indexes. So if the index is up 10% that month, I'm going to be up 30%. I could always do that. I had this conversation with an investor recently because the investors, this particular investors, I don't know if enamored is the right word, but enamored with triples. Why do anything else? We can have massive upside. Okay, I'd say, hey, I'm happy to do that for you. But have you really thought about the opposite, right? Because the risk is triple, right? It's not that simple, right? If you want triple performance, you have to take triple risk. So you have to figure out what your correct risk-adjusted rate of return expectation is going to be. And that's the portfolio you have to put together, and you have to be content with that. You got to be content with that. You get on a move, the market goes up. In retrospect, we always knew it was going to go up, right? You don't. So you got to make an intelligent decision, and then there's risk. Figure out what your risk-adjusted rate of return that you want. How much risk do you want to take for the reward you're trying to capture? If you can honestly say that you want to put triple everything in your portfolio, then the market, put all the capital to work, market drops 3%, you're down 9% in a week, right? That could happen. Put a position on, market drops 3%. That's not even that's just a bad week. I mean, that's just a normal bad week in the market, and your portfolio just dropped 9%. Are you okay with that? Do you see what I'm saying? And I don't think enough people think about that when they're building a portfolio. So I share that thought with you this morning.